All right, there we go. So we're running a little bit late. Good morning, Dwayne. How you doing?
Good morning. How's it going?
Oh, good. Like I said, I'm in a different location today. I had to come down to Fort Lauderdale and uh, take care of some business down here. So, anyhow, I'm so sorry for being late, everybody, but got some great information as always for you. Another case study, another student. Last week we talked about one of the other case studies that happened very quickly for those who want to move quick in the industry. If you've got someone like myself to guide you through that, and there's really, let's face it, there's nobody giving the one-on-one attention that is really needed if you truly want to get accelerated results. It's working with somebody with experience and like myself, and that's the best way to go. We talked about that. We've talked in the past about comparing the real estate note business to other categories of investments. And I thought today, what we talked about, Dwayne, is a little bit more on non-performing notes. You know, there's some speculation that we're going to start to see more non-performing notes in the future if inflation keeps going up, if real estate, which is we're already starting to see real estate starting to peak out. Some areas it's actually going down in value a little bit, adjusting, if you will. Nothing drastic, but certainly is some expectations that uh, banks and such are going to start to have to take these loans back, and they're going to start to dump them.
Yeah, absolutely. I
Yeah.
mean, we see that happening now, um, for sure. Absolutely.
Yeah. And I think what's important for people to understand is the way the banking system works in dealing with delinquencies on real property has fundamentally changed. And a lot of people are not aware of that because it's wrapped up in the Dodd-Frank Act. And the Dodd-Frank Act that came out after the last great recession, if you will, when the real estate financial market crashed, it fundamentally changed the way banks look at these assets. Instead of going down the traditional road of foreclosing on a property, which there's still a little bit of, and there's always going to be a little bit of, but it's about point one, it's about 1% maybe of the entire industry right now, maybe a little bit less than that. So it's very, very small because in the background, banks are forced to have large cash reserves if they have a lot of these assets on their books. So instead of going down the road to foreclosure, what they do is bundle up these notes and they sell them on the open market to big, big, big buyers, right? People that will come in and buy 200 million to $1 billion worth of notes at one time. That's why you see when you look at charts, the foreclosures that have been completed have just draft excuse me, just fallen off the cliff. And that started in the last crash. That banking system is not going to change. So, for those of you who are real estate investors looking to buy real estate, one of the ways that you always looked at that was go to the foreclosure sales. Well, guess what? There is fewer and fewer and fewer of those foreclosure sales, and there's more and more competition because you have real estate investors that don't really understand what's going on going to these sales thinking that's where the good opportunities are, and they're paying too much.
Yeah, and the issue that I hear with talking to people all the time is that they don't have inventory. What should I do? Should I go to these foreclosure sales? And I'm like, where are they at? It used to be plentiful. You go to county courthouse and they'd be throwing out 80 to 100, 200 at a time.
Yep.
Now, the game changer has been, back in 2008, 2010, when, loss mitigation department was really involved. And then you had all these non-performing assets. And then the hedge fund companies came in, got in the big play. And then, boom, there's your inventory. So we have seen, excuse me, that shift of more of these hedge fund companies. That's where you're getting your assets from.
Yeah, yeah, and again, it's not going to change everybody. So you either need
Yeah.
to adapt to the industry, or you're going to be fighting over deals that you're going to end up fighting to pay more for, and that means your profit margin is going to be shaky. And I think that's another reason why we've seen more non-performing notes on short-term loans that were meant for rehabbers, because the rehabbers are getting in these deals, they're overpaying, and they start to realize that after they get the loan, they start to rerun their numbers. They find out that the cost of material for houses now, the cost of labor for houses now is more expensive. And when they go back and recalculate those numbers, all of a sudden they go, geez, between this, the loan, the expenses that I have, at the end of the day,
There's nothing
to
left.
be able to sell this thing for enough money to make a profit. So I'll just stop paying the loan right now.
Yeah. You have to be real creative, and that's this market. A lot of people they think they keep operating back 10, 15 years ago, and times change. Just like, and you made a good point, and I was getting ready to say, the investors have to change and adapt to the market for the way it is now, not the way it used to be. Market's
Right.
not going to change just because that's the way you did things. You have to be more creative. You have to have the in, like that you've created with the relationships with these hedge fund companies, to where your students are buying assets. So obviously they're wanting to deal with you. And so you either have to have an in, something like that, or you have to change with the market and be real creative.
Yeah. Laws and technology are always going to fundamentally change what's going on in the real estate business. And we're seeing more and more of that. So for those of you who are looking for ways to not only invest in notes, but also invest in real estate, I got news for you. You can do that through notes. And you're going to do it with less money, higher profit margins, less risk, and everything else because of the way the foreclosure process starts to work. So let me just lay that out for you briefly, and then I'll go to a case study on a PowerPoint in just a minute here. But when someone's in trouble financially affording their mortgage payment, 30, 60 days is kind of no big deal. They get letters from the servicing company saying, hey, your payment's overdue. Please contact us, those sorts of things. By 90 days, the letters get much stronger. And after 90 days is when the option for the note owner, whether that's a bank or a private individual, that's when they can start the foreclosure process. Okay. The foreclosure process in every state starts by some kind of a notice. Okay. Whether it's a judicial foreclosure or non-judicial foreclosure, it starts with some form of a notice. And that is a part of official records that gets put on real property records. It gets mailed to the borrower as well. So the foreclosure process then has started, but foreclosure can still be quite a ways down the road. This is where it depends upon the state and whether the state uses a judicial system or a non-judicial system. So as this process starts to play through, real estate investors don't see that property as a foreclosure yet. You can't buy it on a foreclosure list because it has not been foreclosed upon. Real estate investors who go to the sales, that's when the property has been foreclosed upon and you're buying a foreclosure. Everything else leading up to that is pre-foreclosure. And real estate investors don't get that information. Now, you could do a search and find out who has these notice filed upon, and you can start to send out direct mail and that sort of thing. But that puts you in a whole different business. As a real estate investor, you're looking for deals. Now, some people do take that method, but I'm telling you, that's going to be an expensive way to go. You're going to send out a lot of letters and get usually no response from those letters because people still have a chance to work those out. So it can be done. You can buy lists like that, but you're in the direct mail business as a real estate.
I had a lady that called me about 2, 3 weeks ago who was a long-term student, and she said, "Listen, my neighbor's got this property, two houses down that I'm trying to buy, and they can't make payment. How can I find out? And can I just go buy that?" And I said, "They're first of all, they're not going to deal with you. How far are they behind?" "Well, they said they're only about 3, 4 months behind." I said, "That's in a pre-foreclosure state. I mean, it's nothing you can do right now."
Yeah. So with note investors, it's a little bit different because we're not going in there to buy the property per se. We're going in there to buy the debt on the property. And then if we can work with that person and do some kind of a loan modification and a workout, fantastic. If we can't, we end up with the property or get paid out at the foreclosure sale. So it puts us at an advantage position because we see more inventory there than you're ever going to see that eventually make it to the foreclosure sale. So you can buy real estate through buying the debt first. It's quicker. You have more inventory. You have less competition. You have less risk, higher returns. It's the best way today to do it. There's no question about that. Now, you can focus if you truly just want the real estate and you don't want to do really a workout with somebody, you're just looking for property, this is where you can buy non-performing loans on vacant property. Okay, so you can specifically target that. If it's a vacant property, there's going to be, very less of a chance. I mean, a very minimal chance that someone's going to come back and want to try to negotiate that. When they've left a house, they've left it mentally, financially, everything else. They've moved on with their lives, and they would like to close that chapter out. And those are the kind of deals that you can come in and buy those very inexpensively. And that's the case study that I wanted to share with you today. So let me go to the screen here. Now, this is a very recent deal. And like I was saying, I haven't seen many people take this approach yet to these kind of notes, because we don't have a whole lot of those. In the last crash, we did. So we are likely to see some more in the future. So this is going to be a technique that you're going to be using in the future. But this one is currently going on. In fact, I just received yesterday an email from the note investor, student of mine. Obviously, he's one of my mentor students that got into this deal. And by the way, before he got into this non-performing note, he's been with me maybe coming up on 2 years, maybe a year and a half. He's got about 16 notes, all performing notes. And then he decided, I want to go into a non-performing, but I really want to just end up with the real estate. I want to go through that process and learn about that. So this was a perfect case study for that. So on this loan, you can see the unpaid balance, UPB, is $30,000. Okay, and I rounded it off a little bit there. It has a legal payoff of $37,140. Now, the reason there's a difference between those numbers is because, well, it's non-performing. So at some point in time, accounting-wise, we stop adding to the unpaid balance and just say, okay, here's the unpaid balance, and now we're going to start drawing up this arrearage account. And in this case, that totaled $7,140. And that's why the payoff is different there. So the last payment that was made on this was in 2021. Now, again, he just bought this note maybe 6 months ago. Okay. So bought it in 2024. The last payment they made was 2021. Severely delinquent. Every indicator that this house has been essentially abandoned. Just sitting there, nobody living in it, no work being done on it, nothing. That payment, by the way, in 2021, you can see applied to 2020. Okay, so this person had gone into a seriously delinquent scenario. It could have been tenant occupied, but we had no indicators that it was. So sometimes in this business, like most investments, you have to take an educated risk. Were we 100% certain that this house was vacant when he bought it? The answer is no. But everything indicated that it was. And that's part of that due diligence process, that's so important. And that's why I just drill down on people. Look for this. Are they paying the taxes? Are they paying utility bills? Is the power turned on to the property? We can go into a deeper due diligence to find that stuff out. So in this case, didn't quite know, but pretty much we're sure that it was going to be vacant. Even if it was tenant occupied, though, would we have a solution that was still going to financially benefit us and possibly also help the homeowner out? And the answer is yes. So you have to think through all of the potential exit strategies in a case like this.
Did he not have a door knocker or somebody to go out? He didn't have an agent or somebody go look at it.
I can't remember if we sent a door knocker or not. It sounds like we did, if memory serves, but I don't know 100% for sure. But that's another great technique that you can do, of course, Dwayne. And you're right. Send a door knocker, somebody to, hey, just wanted to see if you were the
just
owner
a wellness check,
that sort of thing, And so I know that conversation came up, and I can't remember.
Yeah.
But it sounds like a logical thing to do, because we weren't quite sure. He really just wanted the real estate. But if it's tenant occupied and the person's not paying the mortgage, you can get an assignment of rent, and that way the rent comes to you instead of the borrower, and that's a court-ordered situation. So we had that scenario, and then if we could engage the borrower, we might be able to get the loan reperforming. So we had a backup strategy for that either way. But based upon some other pictures, we must have, because I know we had some pictures of the side, and there was some accumulated just junk, back there. So it indicated probably vacant. But either way, those are the kind of things that you start to investigate. And it looked good enough because we did before we closed on it. So we do all of this due diligence and everything, right? We looked at the taxes were behind and that sort of thing. Another indicator, probably no longer living in the property. And that's another problem we would have to cure. But as we got our research done, everything seemed to indicate the property was worth, somewhere around $65,000 on this. So as a note investor, we're buying this delinquent note. The house is worth $65,000. The unpaid balance is 30. The UPB is 37. We were able to get this note, or he was able to get this note under my guidance, if you will, for $16,500. Now, if this house went to a foreclosure sale, it would have been selling based upon the 65,000 bucks. It might have sold for 50 grand, 45 grand. That's what you would have got it if you went to a foreclosure sale, because on the foreclosure sale, you're buying it with this property value in mind, and you're going to renovate it. On the note side, we're buying this delinquent note from this note owner, and we're basing it not only on the property value, but the unpaid balance to pay off and everything else. So imagine being able to buy a house, a $50,000, $60,000 house for $16,500. So any real estate investor, you tell me where you're finding deals like that. I'd be curious to know. Because the only way that when you look at the marketplace, that's going to work is by doing it this way, buying the delinquent, the non-performing note at a deep discount. So that was a great purchase, a great buy. There's your taxes that were delinquent. So we didn't have any surprises that the taxes were delinquent. The previous note owner had been paying property taxes to prevent a tax foreclosure sale, but they hadn't paid the 2022 taxes. And so we had to go through and look at that and look at the 2023. And those were other expenses that we're going to have to, my student's going to have to incur, namely this one, because that's the one that's most delinquent. The rest will get worked out. So fully aware of that, do all of our research on the taxes. So we got the entire history. We did make an offer on it for $16,500, and then consulted with an attorney. And I wanted to bring that up because sometimes you do want to check with a real estate attorney in that state before you go into a deal like this. There were a couple of reasons for that. Number one is statute of limitations. Okay. Eventually, if a debt collector or note owner doesn't keep pursuing this debt, if there's a period of time that goes by, and it varies by state, the statute of limitations is run, and then that debt is negated by the court. They're saying, look, it's been, and I'm just going to use a number, it depends upon state, but it's been 7 years and they haven't, received any kind of notices or anything else. So you gave up on that debt is essentially what the court's saying. So we're going to dissolve it and you can't collect it anymore. So statute of limitations was one thing that we wanted to check. The other thing was this contract for deed. And boy, that's been a conversation over the years, a contract for deeds. The contract for deed depends upon state law once again. Some states have a law specifically on contract for deeds. Florida, Michigan have one. This happens to be in Michigan. And Michigan does uphold the law when it comes to contract for deed. The contract for deed is a type of loan that you promise to pay it back, but the owner of the property is going to be the note owner as well. So they still have legal title to the property. So possession is 9/10 of the law. So if I was selling a property to Dwayne under a contract for deed, I'm essentially saying, Dwayne, I'll sell it to you. You give me a down payment. You give me the promise to pay me back and start making monthly payments. When you pay me off in full, then I'll give you full legal title to the property. Okay. So he would have to pay me off in full to do that. So what that prevents is a foreclosure. Because if we buy the non-performing note from the current note owner, we go on the deed to the property. Okay. So the deed to the property was transferred, as you can see right there. Okay. So when my mentor student bought this, he got the deed to the property. It was quit claim to him from the previous note owner. Okay, which is significant. So he's already on the title. So now what he has to do is essentially evict the delinquent borrower under this contract for deed. That's not a foreclosure process. It's a much more streamlined process. And normally when you do that, especially on an abandoned property, the borrower is simply going to say, I'll just sign it over to you. I'm done with that property. I'm done with that debt. And the agreement is I sign it over to you and you forgive all the debt.
Right.
Great, right? Well, that didn't happen in this case. the delinquent borrower wanted to fight it. So he got an attorney, very unusual, to fight it.
Really?
And yeah, and it went to court, and they had nothing to stand on. He couldn't prove that he was making the payments on anything. He was under a contract for deed. It was very clear that we can accelerate the entire loan. It's due, due in full. So that clause was enacted, and he had 30 days to come up with all the money. Okay, so the delinquent borrower did have a window, a 30-day window after he lawyered up to correct this, which was by coming up with $37,000.
Wonder
And
if he understood forgiveness of debt. So if he thought that he could just walk away, because we saw that years ago in the big debacle of Florida,
yeah,
homeowners thought, hey, I could just walk away from it and not have to pay anything.
I think this person became aware of the fact that they were still involved in the house, number one, and number two, that the property values, again, this is in Michigan. So Michigan took a deep turn on property value.
Yeah.
And then all of a sudden it
Sure.
started going up again. So I
Yeah.
think he started realizing that, hey, this house is worth more than I thought. Maybe I can sell this thing, which he had a right to do, or I can come up with the $37,000 from a bank and maybe renovate it, or from a private investor, something like that. So I think he was thinking he could save it and make some money out, and he had an opportunity to do it, but he didn't come up with the $37,000 to pay it off in full, which my student client would have gladly taken. He invested
Sure.
16,500, a couple grand for an attorney, and would have got $37,000 back, within a total of less than 60 days. Sure, okay,
Yeah, sure.
that could have worked, but he didn't come up with the money, and he didn't have the ability really to pay. And it's tough to work with somebody who's abandoned the property and hasn't made a payment since 2021. You know what I mean? It's like you got to come up with something. I mean, you got to come up with a large reinstatement fee or something to show us that you're going to continue on with this.
Yeah.
And so the guy at some point just ran out of time, and the law just followed through as it exactly did. And then it gave him time to remove any personal property. So that took another month or so to take care of. And all of that, he had nothing really in there. So essentially that was it. It was done. The notice was filed. My client was, as I showed you already, on the deed to the property. Now this person has no rights to the property at all, and he owns it. And I as I said, just received pictures today of the inside. Because that was one of the things we didn't know on this was, I wonder what the condition is on the inside of
Oh,
the property, because we have no right to go in this property in these contract for deeds unless it's specifically in there that the note owner has a right upon reasonable notice, which it is sometimes, to go in and check on the property. Otherwise, we have no right to do it. So you do take again, there's risk in investing as to what that might look like. usually the outside reflects the inside, that sort of thing. So we knew there were trash around the back and everything. Not trash, but just
House don't look bad. I mean, the roof doesn't
doesn't.
look bad. The
No,
guy didn't take the chair or the direct TV satellite there on the side of the house. So
yeah. Yeah. So, by the way, if you're buying property at a foreclosure sale, you don't know the condition of the inside of the property either, unless you've broken law and went into the property, which happens all the time. But you're not supposed to. So, if you're buying a property at a foreclosure auction, you don't know what the inside looks at either. It's an investor's risk that you take. So, you make assumptions of what it might be worth. And so I just looked at the pictures today, and it's a typical rehab. So it's going to need new electrical. That's very clear. Not a
mm.
whole new rewiring, just outside panels, reconnected, all that sort of stuff. It probably going to need. It looked like some of the HVAC downstairs, although I do see a window unit up there. But it looks like that might need some work. Other than that, it's the normal stuff. It's painting, it's floor, it's kitchen, it's all that. So it doesn't look bad. So the after repair value on this thing's about 80 grand. As is, it's worth about 65. So again, he's in a power position because he's in this thing maybe now a total of $20,000 when you add in the attorney and everything else. So what could he do? Well, we ran through every scenario, right? We're like, well, you could sell it as is cash, to an investor, because after they fix it up, it'll be worth 80 grand. So we can back into a number there. You could turn around and sell it with financing to a rehabber. You could fix it yourself and then turn around and sell it for cash, or sell it with financing. I mean, so we ran through every single scenario. So now that he's got complete access to everything, what's the next phase? Well, the next phase is gathering more information, okay, which is, what's it going to cost to fix this up, right? So he's got 3 or 4 different people coming out to give an estimate, and that way he can start to back into a price, put this thing on the market. He'll probably just sell it as is.
Is that what he wants to do?
To a rehabber. I think that's the first thing he's going to
Yeah.
do.
Yeah.
Yeah. But again, when you can
Hey,
get
listen, he got himself some experience. I mean, you were able to walk him through, several scenarios. Number one, he wanted to buy the property. He wanted the property to go through, and he bought himself some experience and can make some money on top of it.
totally
And
make some money. Like I said,
yeah,
where else could you buy a house like that for 20 grand? I mean, that's essentially what he has, all costs, included, is about where he is. So
and you,
yeah, a lot of upside on it. If he turns around and sells it for 50 grand, you think about that. You invested right around $20,000. Now you got 50 grand back in a total of 6-7 months. What's your return on investment there? I mean, it's huge. So he's got a lot of different ways. I don't know if he's going to want to take on a rehab himself and then turn around and sell it coming into September, October, November. So the window of rehabbing a house up in Michigan is getting smaller, is what I'm saying. So he may want to just turn that over to somebody local that can just go in there and knock it out, because it won't take. It's a 60-day rehab. It's not from what I can see.
yeah.
Yeah.
You made a great point earlier about Michigan. People ran away from Michigan for investment properties before, and now, the city and the surrounding counties have pumped a bunch of money into the state, and they'd leveled a lot of the homes and stuff like that. But it's really, really has come back. I have a friend that lives up in that area, and they said, what a difference 5 years made. From the way it used to be to where it is now. Every city and state has bad areas.
Yeah.
However, the state itself is really trying to change, their housing, their investments out there. So it looks like a pretty decent deal.
Yeah. Michigan made an aggressive move to tear down the abandoned properties. And a lot of people were, how's that going to work? You can't tear down somebody's house. And they put notices out, and they said, here you go. And you've got this amount of time. Otherwise we're tearing it down. And that was a good thing to do. Because
It was.
having vacant properties just sit there, it just attracts rodents. The property lawns have to be maintained. The snow has to be removed. That's all added cost. People break into the houses, crime goes up, police presence has to, cost more money going around. It costs a lot of money for cities to take care of those things. So it was a
Yeah,
smart move on their part. And
absolutely.
yeah, so he's gonna do really well. So another way, everybody, just in real estate notes to more opportunities. I mean, there's so many different ways you can go. You can buy performing notes. You can buy partials. I'm going to do that, I think, next week. We always talk about selling partials, but I'm going to show why it's important sometimes to buy a partial. There's opportunities in the non-performing notes to do workouts, to get government money, to even buy real estate. So it does a lot of different things. So if you're a real estate investor and you haven't added notes to your business, you're just missing out on opportunities. If you're brand new to real estate, consider jumping into notes. There's more opportunities here, better opportunities that are safer for you, and more predictable as to what returns, what overall returns are going to be as well.
Yeah, and we always talk about just because you're a rehabber doesn't mean you have to stop doing rehab. It's just another add-on that you can go do, to your business. You
Mm-hmm.
know, we have a lot of students that do that. They do rehab, they do wholesaling, and they added notes one because, well, they can't find the deals, but yet I can find the deals on the note side, but I can use my knowledge to rehab the property in this situation or whatever that looks like. So everybody thinks they have to just quit doing what they're doing and go learn the note space, and that's totally not true.
Right. Great. Well, everybody, I hope that you enjoy this series. Love to hear from you. If you do like it, just send us a little notice. Let us know that you're listening and watching. We do appreciate that. Info at Kevin at Kevin or info at kevinshortell.com. It'll be on the link as well. And let us know if there's any topics that you want us to
Yes, I was getting ready to
discuss. We're
say.
open to that as well. We're going to have some live events coming up in person and online also. So if you'd like to stay in touch with us, just go to kevinshortell.com, sign up to get on the marketing list, and we'll let you know what we're doing, where we're going to be. We have a big noteworthy convention that we're going to be a part of coming up early next year as well. So a lot of things going on for you. So you can go to kevinshortell.com and get on our mailing list. And I don't bombard you with a lot of stuff, but we will keep you in touch with everything. And again, if you have anything you'd like us to cover on this, if you enjoy this, please just give us a little shout out there at info at kevinshortell.com as well. Anything else I missed there, Greg?
No, I was getting ready to say they have questions or comments, something that they've experienced that they want us to go over ahead of time, send it and we'll be glad to cover it.
Sounds good. Okay, everybody. Until next week, we'll see you on the next Water Cooler Wednesday.